I'm Fred SaintAmour with Boathouse Commercial Funding Group, and today we're talking about all the different loan programs and loan structuring concepts that you might not know about that are for landlords, real estate investors, and entrepreneurs. It'll help you grow your portfolio and give you a roadmap to keep building the amount of doors you have.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owners Association, where real estate investors have found success since 1968. I'm your host, Brian Hamrick from Hamrick Investment Group. This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 538. Today, we're talking about creative financing and why most investors misunderstand leverage. Too many people chase rate and ignore structure. They do not know how to qualify, how underwriters really assess risk, or how asset-based lending looks first at the collateral, not at your W-2. The result is slow growth and missed deals. My guest today is Fred SaintAmour. He does loans for landlords, real estate investors, and entrepreneurs. He's closed over 200 hard money loans through Boathouse Commercial Funding Group, and he's been structuring commercial debt since 2010. A former U.S. Army Ranger, he brings disciplined underwriting and a clear lens on risk, reward, and speed. Fred, welcome back to the show.
Thanks, Brian. Glad to be here.
If you're listening or watching this on the Monday, April 27th, when it comes out, Fred, you and I are both at the Midwest REI Real Estate Investor Conference here in Grand Rapids at the DeVos Place Conference Center.
Swing on by and come see us.
You're the main sponsor. What does that make you? Like the premium, platinum, diamond? What are you exactly?
They call it the underwriter, the conference underwriter, but underwriter to me, being in the mortgage industry, has maybe some negative connotations. So head sponsor, I guess I'd go with.
Well, thank you for that. Thank you for your support of the RPOA and the conference. And again, if you're listening to this right now, April 27th, 28th, DeVos Place Conference Center, Midwest REI Real Estate Investor Conference happening right now. Come on down, be a walk-in and check it out. And come meet Fred, and I'll be there too. So come say hi. But anyway, let's get into the episode, Fred. I really think that the topic for today is just kind of like, it is kind of about underwriting and looking at the projects and the deals that people bring you and their perceptions of what it takes to get a loan versus reality. So can you kind of just fill us in to start with on what investors and people who come to you typically bring and what they expect?
Typically, what the financing that people know about is the financing when they bought their first house, the Fannie Mae, the Freddie Mac loans, where they want tax returns, W-2s, and pay stubs. And they underwrite it, like, where did this $37 come from? Or, oh, I'm sorry, you only have 20 months of job time, we need 24 months, and all that strict standard underwriting that's set up for consumers. We do those type of loans. I'm a licensed lender, and we do, when I have to, do I do like the Fannie, Freddie type loans. We specialize, though. 99% of our loans are to landlords, real estate investors, or entrepreneurs, where we don't need the tax returns because, our clients have $2 million worth of property and they lost, $25,000 every year for the last 7 years on their tax returns because they're using, write-offs and whatnot. We ignore that personal income based upon tax returns, W-2s and pay stubs, and we use the income of the property to qualify. And we do it on 1 to 4 families or 20 units or whatnot, but we look at the income of the property, discern if the rental income can pay the mortgage, and if so, then we use that to prove the income and close the loan.
So Fred, what do investors typically misunderstand about how lenders like yourself assess risk?
The biggest thing lenders look at is, can the mortgage payment be made? And it sounds pretty simple. But if your tax returns or your W-2s and your pay stubs, if you have a job as well as investing, don't qualify, then we look at other avenues to prove the income. One I mentioned, if we give this guy a mortgage and we figure out his principal and interest payment and his taxes and insurance, include that, is the rent more than that? And if the rent is more than that, then we say, yes, this property can pay for itself, right? And we don't look at the 4 or 5 or 20 other properties that the investors have. We just look at this one single property. Just like we'd look at it if you're buying a 100-unit apartment, can the apartment pay for it? If you're buying a single family house, can the rental income cover the principal, interest, taxes, and insurance?
What you're talking about right now is debt service coverage, right?
Yep. It's called debt service coverage ratio, which is a big, long mouthful. That means, is the rent more than the PITI?
And what is that ratio? Where do you like to see it fall? Because if it's one to one, then basically the property's making just enough money to pay the loan, and that's it, after all of the operating expenses. But obviously you want it to be a better ratio than that. So where do you like to see it fall?
At least 1.05. So that's the lowest we can go. We like, and so does the investors, 1.25. So, and that, is the rent 5% more than the PITI, or is the rent 25% more than the PITI?
Debt service coverage loans, are somewhat popular right now and very, very, always very important in the commercial world. But if the property doesn't meet that debt service coverage, are there other types of loans? And I'm thinking specifically of asset-backed or collateralized loans that you can make. And can you kind of share what the range of options are in that space?
In most loans, we have to show that the property can pay for itself or that the borrower can afford it, right? So we do, tax returns, W-2s, pay stubs. If that doesn't work, we'll try DSCR. If that doesn't work, then if they're self-employed, we can use either the deposits going into their personal account. We can use 100% of that, which we do sometimes. But then the other way is to use 50% of the deposits going into their business account. Now, with landlords and real estate investors, you get all that rent coming in, and we can use that rent to prove your income. We add up all the deposits over 12 months, divide that in half, and then we use that as the annual income of the borrower. And it works fantastic for investors. And then lastly, asset-based, they're usually liquid assets. We look at someone's liquid assets. If they have $1 million in an IRA, then we say, well, the guy's got $1 million. I think we can lend him 500, right? And then there's some loans, Brian, on our private money loans or hard money loans, where we just look at the value of the asset, right? If we're at 65%, 50% loan to value on a property, we hope the people pay us back. Obviously, we don't want to put them into a bad loan, but we'll lend on the value of the property, and we won't even check income. Those are short-term bridge loans while you stabilize or rehab a property or whatnot. But there's a whole different menu of options out there for landlords, real estate investors, and entrepreneurs.
You and I have done a number of hard money loans, private lending type loans together, where the borrower comes to you and you assess the risk and look at the properties. And then I bring in the equity or the money to actually lend on those loans. And I know that on a lot of them, it's often the case where the property itself doesn't have enough value to justify the amount of the loan. So you'll go and look at other properties that the borrower might have that are free and clear, and where you can put first liens on those properties too, so that you get that loan to value down below an acceptable level.
Yeah, they're called hard money loans, meaning you're lending on the hard asset, but it's really common sense loan. If a guy has a property, we do a bunch of these. A guy has a property free and clear. He needs to close on this one. Maybe he makes a cash offer, so he has to close in 15 days. We'll just go ahead and lien both properties and give them the money to close. And then, they rehab or stabilize the property, and then we go for long-term financing. Do it all the time. And my point is, it makes sense. If we're at 50% loan to value on two properties from a lender standpoint, the guy's not going to give up all that equity. He's gonna pay us and pay us off, right? Quite frankly, if he doesn't, from a lender standpoint, we're still going to be okay if, God forbid, we have to take the houses back or whatnot, which we try very hard not to, but it happens.
What makes collateral strong in your eyes, or conversely, what makes it weak?
The biggest thing we look at is marketing time. So if unique properties are tough and rural properties are tough, just because, and again, we don't want to do it, but if we take a property back, how long do we need to hold the property, in order to get rid of it? So those are the things. The biggest thing is marketing time, and it comes into play with unique properties, maybe a mixed use property. I'm trying to think of a couple examples, this property is so unique, we love it, we have to have it. And I'm like, well, how many other people find it unique and that they have to have it? So I'd say marketing time we look at. Rural properties, again, we get a lot of these, $1 million homes in the middle of nowhere. Well, we're at 50% loan to value, but still, how long do you have to hold $1 million property in the middle of the mitten in Michigan to liquidate it?
What would immediately disqualify a deal?
Fraud. And that's from the borrower standpoint. If there's fraud in the past, we just don't do it.
Are you able to detect fraud when you're doing your due diligence on the borrower?
We do a soft credit pull just to see where we're at. And we do that mainly to make sure if we lend on a hard money loan or a private money loan, that we can get the borrower out of the loan. So we always check the exit plan. So we'll take a look at the credit, see if there is even a credit challenge and how to rectify it, and then a background check.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB and Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com. What are the mistakes you often see borrowers make when they're trying to qualify for a loan?
Just tell us everything up front. I think they're used to dealing with banks and bankers, and they try and, or they give us a half a story and not the full story. Just tell us everything up front. We're going to find out about it anyways, whatever you're trying to hide. And, we really try and partner with our clients. If we know there's some sort of, skeleton in the closet, we can work around it. Just let us know what challenges you're having, and we'll structure a deal that'll work for you.
As an investor is putting together everything that they need to bring to you in order to start the conversation, what should they have prepared?
Again, I go back to banks and Fannie and Freddie loans and tax returns, W-2s, pay stubs, and this and that. We really just need like the entity docs. We need, if it's a DSCR loan, a copy of the lease. If it's a purchase, we'll use market rent. So really entity docs or the HUD from when you bought the property. If it's a refinance, it's really simple documents that any semi-sophisticated investor would have.
You mentioned W-2s, paycheck stubs, all that. That's not important to you. Is that what you're saying?
I don't want them. I'm not interested in them. I already know what they look like. You lost money again this year. I get it.
How important is the credit score?
Again, it depends. I just did a 30-year fixed loan on a guy with a 498 score. It was a 50% loan to value. The interest rate was at like 9.8, but it was a 30-year fixed at 50% loan to value. For the next step off point is a 660, and that's going to take your loan to value up to 65, 70%. And then once you get above 680, then we can do 80% financing. So, credit scores is a factor, but not the end all be all. It helps for sure.
What speeds up the process and what slows down the process when you're working with the borrower?
My background, what I is in operations management. So what my degrees are in and everything like that. So I have a system set up where it's almost automatic. And so if we ask for something, if you take 2 weeks for us to get it, that's going to delay the loan 2 weeks. On a fix and flip loan, well, we need your budget, what you're going to do to the house. And because we give that to the appraiser and we say, hey, what's this house worth? And if we do X, Y, and Z to it, what's it going to be worth when it's completed? Well, we can't order the appraisal without the budget. And if you're trying to decide on finishes, which, isn't that big a factor, that's going to slow us up. So the biggest thing is when we ask for something, we need it. And then the only other thing that could slow us up is a lot of times tenants on a refinance. They won't let you into the apartment, and so you have to give them notice and blah, blah, blah. Our first loan with an investor is going to take right around 30 days on a DSCR loan. And then the subsequent ones, once we underwrite you, we don't have to underwrite you again. We're just underwriting the property. So we already have the entity docs. We already have your credit report. We already have your background check. So, just get us what we need in a timely fashion.
Let's talk about interest rate here because, these types of loans usually have a higher interest rate. But can you talk about the relationship between like the higher interest rate loans and the other terms like speed and certainty to actually closing?
Well, I'm going to push back on you a little bit on rates are higher. So, hard money loans, short-term bridge loans, that's going to be higher interest rate because they're riskier. But on a 30-year DSCR loan, you're buying an investment property. On a 30-year DSCR loan with 20% down, the rate is lower than a Fannie and Freddie investor loan where they're using tax returns, W-2s, and pay stubs. So, and rates are coming down. So, I think even with our loans, when you look at certainty of execution, because we don't need all the nitnoid stuff that a Fannie Freddie loan offers or requests, it's more certain. If we know the rent, we know the taxes, we know the insurance going in, our loans actually have more certainty than a Fannie Freddie where they're looking at job time and tax returns and whatnot.
But still, let me rephrase the question then, because a lot of people think, I want to make sure I get the best rate possible, the best interest rate possible. But then there's other things that they should be considering too. And I know in every loan or refinance that I've done, depending on the property and the investor structure, I'm looking at different things that take priority. Like, for example, you mentioned Fannie and Freddie. A lot of my Fannie and Freddie loans require or used to require escrowing the property tax, insurance, and they would collect that every month at a amortized rate. But lately, when I refi, I have pushed to keep my own escrows. So the escrows are self-held. That way I can get, some interest at the bank for them. So that's become more important to me than even rate. And then just some of the like other flexibility, speed, and things like you just said, not having to present a lot of the documentation that they require and jump through all the hoops. But what are some of the other terms that people should take into consideration as they make a decision on what type of loan they should get?
A few things. With our DSCR, so I'm doing a portfolio for an investor right now. And by portfolio, it's 6 properties in one loan, which he currently has with a bank. And every year he has to submit his financials to the bank, and they re-underwrite the loan with him. And it's a 5-year arm, so it adjusts and everything like that. So that's a consideration. The banks, if I went head to head with a local bank, the local bank might be a quarter less, but it's on an arm, right? Banks only do arms to protect themselves. So I would look at that, the reporting requirements down the road. With our loan, it's a 30-year fixed. We set it and forget it, and never ask you for another piece of documentation. Another thing to consider for financing is banks will limit you to 5 loans or $2 million or 8 loans and $3 million. We'll give you 100 different loans. And then the third thing is, like, we make loans to LLCs, right? And it's guaranteed by its members. So when you make a loan to an LLC, our mortgages don't report on your personal credit report, right? So if you have, 2 mortgages on your credit report, it's not bad. 3, 4, 5. As soon as you get that 4th or 5th one, your beautiful 780 score is going to be like a 720. And then you put another mortgage on there, and that's 720, you're a 689 and never missed a payment in your life. So that's another consideration for financing. And then, people call up and say, what are your rates? And rates are important. But I almost had a deal blow up. The borrower called me, did rates move? Did rates move every day? And I'm like, well, let me check, Nope, same. And, he's shopping for 1/8 of a percent. And he bought a property for $120,000, and the taxes were $2,500. And he's worried about 1/8 of an interest rate, and he got no concern that the taxes are, ludicrous. So, interest rates, they're important. They're a part of the equation. But if you're just shopping rate, and not taking into consideration the future financing, you're going to get tripped up.
Fred, is there any advice that's floating around out there, whether it be on social media, YouTube, wherever, that you would like to push back on when it comes to acquiring loans?
I think the biggest one, or a couple, are, we're waiting for rates to come down, or we're waiting for property values to come down, and they're sitting on the sidelines. I think something that a lot of investors miss is that if you buy a house that is worth $200,000, and you have to check it in your local area. But if you buy a house for $200,000, that house should be worth what, $208,000, $210,000 next year, whether it has a 9% interest rate on it, or if you own it free and clear, or you have 80% financing on it, that asset is going to increase. And so, a house worth 200, just for easy math, is going to be worth 210, which is, in the next year, it's going to be worth, let's just say 220. That's $20,000 that you have gained in your portfolio. And again, it's whether that house has a 10% interest rate on it or cash. And so I think they miss out there's a blind spot that, real estate people get wealthy from, getting that property, holding it, and just letting it appreciate. And they get down in the weeds about, is it 6.875 or 7%? That's probably the biggest thing is trying to time the market.
And you see a lot of that going on right now with people waiting for interest rates to come down, which, like you said, they're coming down slowly, but who knows if they're going to come down any further.
A refinance, say it costs you $5,000 in closing costs and fees and everything like that. If you've held that property and went from 200 to 220, if you look at the balance sheet and that's $20,000 in equity that you gained, less the $5,000 for a refinance, you can always refinance and lower the rate, right? And take advantage of appreciation in the meantime.
Tell our listeners how they can find out more about you, get a hold of you, seek your advice about acquiring a loan.
My website is Boathouse, just like it's spelled, Boathouse, and then CFG for Commercial Funding Group, BoatHouseCFG.com. My number direct to me is 269-838-3838. And my email is fred@boathousecfg.com.
I'll throw in a couple things too. Number one is that, like I mentioned in the episode, you and I have been doing some hard money loans where borrowers come to you and you vet them and then put together a loan for them. And then I work with accredited investors to actually cover that loan. So if you are an accredited investor and you're interested in that, get in touch with me. You can go to my website, higinvestor.com. That's higinvestor.com. Or you can talk to Fred and he can give you some more information on that as well. But you do have to be accredited. And then the other thing I want to just plug is, once again, if you're listening to this when it comes out, April 27th, 28th, 2026, both Fred and I are at the Midwest Real Estate Investor Conference right here in Grand Rapids at the DeVos Place Conference Center. And we would love to see you there. So come join us. Let me ask you one last question then. How are you leveraging AI now in your business?
I haven't Googled anything in months. I bounce back and forth between Grok and chat. But even, last week, I tried to find out if the hotel I was staying at had a pool, and I Googled it, and it was a whole bunch of ads for different hotels and sponsored ads. And I went to Grok and said, does this hotel have a pool? And it's like, no. So I'm using AI more so for searches and and for marketing, to kind of spruce up my marketing. I take an ad, put it in there and say, what's wrong with this? Or how can it be better? And does it quickly and easily.
Well, Fred, thanks again for being on the show. Again, I think this is your third or fourth appearance. It's always a pleasure talking with you. And, I learn so much every time about lending and different loan products that are out there. And I really appreciate you sharing your knowledge and expertise once again with us.
Appreciate the opportunity, Brian. Thank you.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's higinvestor.com. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB & Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.